Hello, chart watchers, and welcome to this Wednesday, August 7th, 2019 Market Watchers live show with your host, Tom Boley and Aaron Swenlin. For those of you joining us for the first time today, welcome to the show, and for our regulars, welcome back. Well, the market is struggling to continue the advance it had yesterday. It is actually down again today. The Dow Jones Industrial Average down 332 points. The S&P 500 down 28, the NASDAQ down 48, and the Russell 2000 down 14. The only positive is that we are off the earlier lows, but market's still struggling. 10-year Treasury yield continuing its huge decline since that Fed meeting last week. Today, another 10, 11 basis points down to 1.63%. Hard to believe we were over 2% just 1 week ago. Volatility index back on the climb again, rising 7% today. Still above 20. 24, 25 is a key area of resistance. Anything in the 20s makes me nervous, but if we break back out above that 24, 25 area with the market setting new lows, you want to be real careful. Consumer staples continues to the downside, although today it is the only, well, it was the only, looks like materials has actually turned positive too, but these are the only two sectors that are positive now on the session. Financials really getting hit hard by that big drop in the 10-year Treasury yield. Financials now down for the most part over the last 8 sessions, except for just these little slight bounces from some opens. But financials continuing to get hit hard. Energy also getting hit hard. Crude oil has been dropping as a sign of perhaps global economic weakness, and energy shares following suit to the downside. Industrials, an area that can get hit very hard with the trade war discussion. And you can see the last 6 days, 5 or 6 days, this group's been hit pretty hard. And it was right at a very significant resistance level, trying to break out to all-time highs. So I think this is a very significant pulling back there. Oil, talked about, has been very weak. And this particular group within oil, you can see has really struggled and has now dropped below that early June low. Not good here. Broadcasters having a rough time, mostly because of Walt Disney's earnings. Big shocker there. They did come in below expectations, well below expectations on both revenues and earnings. And you can see the stock being hit very hard, down almost $8 today. Not having that problem, though, is Match Group. MTCH, huge earnings report here. They beat top and bottom line. And look at the move, up $20 on a down day. Match certainly doing well today. And Aaron? It's hump day. It's the middle of the week. I don't know what the rest of this week holds, but man, we're all over the place this week and last week for that matter.
Yeah, absolutely. It's been kind of a crazy trading week for sure. Trying to figure out whether take the poll, because we're asking everybody, is this the market bottom for the current decline? And I don't know. I got to look at some more indicators.
Yeah, I need to look at a lot of things. And hopefully the market will have some answers for us. But we got a special guest in here. Aaron, it's your dad, Carl Swindlin. Carl, how are you doing?
Doing very well.
We've got you in here because we got a lot of questions, and I figure you've got all the answers.
Absolutely. Know everything.
Yeah, that's what he's been trying to tell me all these years.
Well, I hope he has something really good to tell me today, and I think he does. And I think everyone's going to be interested in the discussion that we have with Carl a little bit later. But Carl, we're going to have you back in here in about 10 minutes or so, if you can hang in there with us.
Okay.
All right, Aaron, what do we got?
Okay, upcoming schedule. Tomorrow we have John Murphy coming on the program, so you won't want to miss that. Next week we have Dr. Alexander Elder on Wednesday. And on Thursday, Julius DeKempener, Mr. RRG, will be with us. Don't want to miss that one either. Today's agenda, well, of course, we just introduced my dad. He'll be giving us a lot of information on what he's seeing in the markets. And then we're going to finish off the show with the 10 and 10. And our first symbol will be Paysine, P-A-Y-S, if you want to go take a look at that. Let's go ahead and get it started, Tom. Technical news and headlines.
All right, sounds good. Well, we really didn't have any economic reports out today. Looking at the 10-year Treasury yield, and of course, I've looked at it short term. I looked at it intermediate term. Kind of went to a longer term weekly chart. I think yesterday looked at maybe 3 or 5 years. I've taken that same weekly chart here and I've actually gone back over the last 15 years just to kind of give you a sense of the magnitude of this drop since the Fed announced. Of course, this is this week. This was mostly from the last half of last week. So if you combined these two candles, it's essentially the last 5 days. And if you go back and look throughout the weekly chart, I mean, maybe back in 2008, maybe in 2011, have we seen anything like this? But going back since the top in October, 9 months, this has been a drop really unprecedented, with maybe the exception of 2008 right here in terms of the percentage and how quickly the yields have moved to the downside. And of course, that's just an indication that a lot of folks out there looking for safety, they're moving into the 10-year treasury or into the 10-year treasury and treasuries in general to avoid the risk. And any dollar that goes into the treasury market's a dollar that can't go into the stock market. And so when we see the yields dropping, a lot of times that makes it very, very difficult for equity prices to move higher. And that's exactly what we have been seeing. A lot of, we've had that since the top here on the 10-year treasury yield. We've had all of the volatility back in the fourth quarter of 2018. And then with the huge drop here, April into May, we had the big drop in the S&P 500. And now here we are again. When treasury yields are tumbling, the bond market is sending us a signal, and obviously sending the Fed a signal as well. I think we're getting the message loud and clear. I'm not so sure the Fed has, at least not yet. All right, earnings. Still a lot of earnings coming out. More second-tier companies, but you can see Disney reported. There's their huge miss. I don't know. They're trying to, sugarcoat it and spin it and everything, but they came up way short of revenue estimates and also way short of earnings estimates, and that's going to be problematic. We'll take a look at that chart in just a second. The other earnings that you see here on your screen, most of which pretty good. Match 49 cents versus 45 cents, but that's just part of the story there. Big, big gap up. We'll look at that chart as well. After the bell today, we've got Booking Holdings. That's the former Priceline. A lot of times we'll get big moves one way or the other on that stock. Be interesting to see what they come out with. Monster reports after the bell. And then a couple that I think are going to be very interesting. Roku. Of course, Netflix not doing well after their earnings. We just talked about Disney, and Roku comes out after the bell tonight. So we'll see whether or not they have something positive to say. All right, looking at some of the earnings reports, let's pull up the charts. First one is Disney. Disney, here's that gap down. I mean, had a nice little run here to the upside with the gap back in April, but this is disturbing. And when you look at what's going on a relative basis, Disney relative to the broadcasters is taking a big drop. I would watch that recent low. I don't want to see that loss. That would be roughly a move to a 3-month relative low to its peers. And then you've got this double bottom, Disney versus the S&P 500, that we're quickly approaching as well. I don't want to see that loss. So maybe if you're holding Disney, give it a little bit of room, but I do not like what's going on here. I don't like that big volume move to the downside to accompany the earnings report. Match Group. Here's the report. This thing has really gone crazy. Let's make sure we got the update here, and it is up it's up to $94, which is a 27% increase off of yesterday's close. And check out that volume. Really hard to argue with this kind of a move. When you get a gap up like this and you continue going higher with this kind of volume, I think that shows tremendous demand. I think Match looks really good here, and I would expect that it's going to be a good performer over the next quarter. A couple of other earnings reports that we'll just take a look at maybe very, very, very quickly. One would be FleetCor, FLT. This is another one that actually you can see gapped up here. Tried to make a breakout, didn't quite get there, but it was a good reaction to a report. And on a relative basis, it's actually moved to a new high. I think that's important. And I also wanted to talk about Wynn Resorts. This was another one along with Match and Disney that we talked about on our poll yesterday. And this was one that we didn't feel very good about going into earnings. And you can see why. We got the gap down. We are down $2 on the stock, or about a little less than 2%. We were down a lot more earlier today, and there's a big support level at the beginning of June that we want to keep a very close eye on, around 103. But look at the relative strength of Wynn versus the gambling index. We are now at about an 8 or 9 month low. I think that's something to keep in mind. It's breaking down. It's on this decline, and really on a relative basis, not looking very good. All right, going back to the dashboard, I wanted to point out under the scooter movers, HZNP right here. And you can just see on that little mini chart, see how it's trying to make a breakout. I've got some concerns on this chart. Let's update it, make sure we got the most recent data here. But Scooter breaks out. It's at 85 above this triple top, which is nice. Right now, we're trying to make a price breakout. That, to me, is more important than anything. But if it doesn't hold the breakout, I've got some issues because the pharmas, number one, are going down, and the pharmas relative to the S&P 500 can be or have been a bit problematic here over the last 7 or 8 months. So you got a stock that's picking up and a group that's not. And so want to be careful if we fail to make that breakout. And the reason being, there was a scooter mover that I talked about, I don't know, maybe a couple weeks ago, Carter Holdings. Remember I talked about that where you got this false breakout? Look at what the stock did after it failed on that breakout attempt. So I'm just going to say on this one, it's looking good. But if it fails to make this breakout, I would be a little careful with it, especially since it's part of a group that's underperforming. So for that reason, it is my scooter mover of the day.
All right, it is time for a couple of upgrades and downgrades. I'm going to go ahead and start with an upgrade with Electronic Arts, EA. It was upgraded by Atlantic Equities from a neutral to an overweight. They did not give a price target, but I was looking at the chart, and it's been in a trading range, for quite a while here. I'm going to mark it from there to back down here. So that's the trading range. It failed to hold that range. It got back in, and now it is trying to fail once again. The PMO, however, is flattened. It is actually on a buy signal right now. And if I look at the OBV right now, you can see that it has been rising despite the decline on the price. So we might be able to see that move to the upside. And I guess on this upgrade, Atlantic Equities is looking for that move to the upside as well. New Relic was downgraded today by 2 different agencies. It was downgraded by First Analysis Securities from a strong buy to a neutral, and then Raymond James downgraded it from an outperform to a market perform. So what we're looking at this point is a neutral positions on the downgrade. I don't like this one. I saw this and immediately was looking at the fact that we have this double bottom here that never actually executed. You can see right here with the trend line, I'm going to draw right across the top. That would have been your confirmation line. We failed there and have fallen right back down. And now look at where we are. We have dropped below, in fact, gapped below that support level at that low we had back in June. So I think this downgrade is certainly merited. To a neutral, I don't know about a neutral. I would be looking as far as the next area of support all the way down here to that $71, $70 range.
Aaron, I don't know if you see that one candle, though. It is actually down below that today. It took a huge tumble today.
Oh my gosh, it did. Well, there you are. It dropped below that support that I was looking at. And let's look back further. Yeah, the volume was a little dark there. All right, so wow, here we go. Let's bring it down to where it is currently. It's now trying to hold this support from back here in October of 2017 and into early 2018. But there's certainly room for it to fall further. I would start looking all the way back here. Let's see if we can get even further. Yep, that would be the area. You can see it lines up with that top back in September of 2016. So we're now challenging lows that we haven't seen in quite some time. So not a surprise then to see this downgrade, but what is surprising is that they're sitting in neutral at this point with that downgrade. So we'll see how that ends up coming out, but there you go with your upgrades and downgrades. Here is the listing for you, and we will be right back with my dad, Carl Swenlin, so stay tuned.
The ChartWatchers newsletter features expert technical commentary about the current market from some of the industry's leading technical analysts. See what's really happening in the markets through their eyes and gain an edge in your own investing. The newsletter is packed full of insightful and educational articles intended to help you become a better investor. Whether you are brand new to charting or a seasoned technical analyst, each edition will provide a wealth of informative content. It's the best way to stay informed on all the latest news, events, updates, and additions here at StockCharts.com. Whether it's a new feature or blog, an upcoming conference, or a special sale, you'll hear it first in the ChartWatchers newsletter.
All right, we are back, and I am very excited to introduce my father, Carl Swenlin, as our special guest today. I know that you have a lot of information to share with us, and I already can see that beautiful yield array chart that you're going to talk about first. So I'm going to let you get started, and I'll be taking questions in the chat room. So definitely lay them out there, and we'll see if we can't get them in.
Yeah, I wasn't planning to start with this originally, but with the yields crashing most recently and today especially, I thought it was be good to look at this. Now, this is from yesterday, updated yesterday. These are going to be lower still when this updates tonight. This is a favorite because it's just so colorful, but this goes back to 1962, and I just trying to illustrate that where we are today is different. It's similar, but it's like to say history doesn't repeat, but it rhymes. Right now, we're getting another. Here we had a drop in yields, and we're into another period where we're dropping, and according to what I've been hearing, we're headed to zero and below. Wanted to emphasize, just look how this is different. This is way different environment than we've ever seen before, and it's who knows what's going to happen. I don't. But it's going to be different than what we've experienced in the past. And I don't think I think it's going to be worse than what we've seen. When, how bad or what, I can't say. But I mean, you look at this and you say, this doesn't look like it's coming up with anything good. They have negative interest rates in Europe and around the world, actually. And I've been trying to figure out why people would buy a bond when they're not going to give you all your money back. Tom, do you have any idea why that happens?
I have no answer for you there. That's a good question.
I mean, why not just leave your money in the bank?
Just give it to me. I mean, I'll just take that difference. That's fine.
Right.
I'll actually I'll cut it in half. I'll take half of what they were going to give.
So anyway, we're heading toward that, and doesn't look good to me. Let me move on to another one of my special charts here. Here's one of my indicators, or a set of my indicators. The ITBM and the ITVM, this is a breadth indicator. This is a volume breadth indicator. Here we have the PMO, and then down here we have the bullish percent index for the S&P 500. We're seeing negative divergences across there. One of the things, though, I looked at this earlier this week, and I thought okay, we're getting negative divergence, but we get those frequently, and in bull markets, they frequently don't really mean anything, much of anything. And now we're going into a pretty heavy-duty decline, and I was just questioning, was there any indicator that really gave us more solid warning on this? And I thought about the moving average chart. This tells us the percent of stocks above, and the percent of stocks in the S&P 500 that are above their 20, 50, and 200 exponential averages. And we had our divergences. Then it noticed this divergence happened way ahead of the market peak, the price peak. And let me just do an inspect here for you to show you how profound this is. This is that top on down to here before the price top. Notice that was 45% fewer stocks were above their 20-day EMA. I mean, that we're talking about each stock getting a vote in here, not just an indicator like the RSI, PMO for that matter. Again, here we had before those recent top dropping down over 40% down of the stocks that were on above the 20-day moving average, and it dropped 40% from that. And just I can't point in all the different directions, but if you noticed on the left side of the screen, that line that moved up and down, it'll show you the percentage from the top line that I drew. We also had the same similar kind of action in the 50 EMAs. There's was in 2018 top. That was down 27. Let's just say for the most recent here, down 19%. The thing is, the 20 EMA reacts faster. And that's something we kind of want to have. It takes a long time for our other indicators. I mean, they sort of follow what the market does. These are showing us what those stocks are doing, those individual stocks are doing. And you can't lose 40% of stocks that are strong and not have some kind of reaction from it. Notice back in that 2018 top, notice there wasn't any kind of a drop there. We got no warning from these indicators. And I'll tell you why. Because this was a parabolic advance. And basically, it just gets things really stretched. It goes too fast, too far. And let me get rid of here. Notice that how far above the average's price was. It got really stretched above. So by the time it dropped down below the 20 and then in 50, it took, it was already well in advance. Same thing would have happened to individual stocks. They were going up in a similar manner, and by the time they finally reacted, it was too late to give us any warning. But I just think maybe it's just me, but I looked at this and I thought this is really profound. It really gives us it gives us direct feedback from the stocks within the average, and the negative divergences here are really meaningful. So any comments on that?
Well, first of all, I think it makes a lot of sense. I mean, obviously, if the technicals are deteriorating under the surface of the market, if more and more stocks are starting to lose key support levels, we know that there's a lot of folks that trade the market and use technical analysis. I don't know what the estimate is. I know it in the past, I've heard 40% of the action that takes place in the market is based on some sort of technical trading. So if you start to see deterioration under the surface of the market, it certainly makes sense that could lead to deterioration in the benchmark index like the S&P or the Dow and so forth. So I would say on the surface, it makes sense. It's not going to be right every time, but nothing is right every time, right? It's a warning.
And it's to me, it's a kind of divergence that you really can't ignore. I mean, you get a divergence in the ITVM Yeah, we get those, and they're a warning, but they're much more indirect in the way we get those indexes.
Hmm.
This is just, to me, it's just, wow, this is going to be near the top of the stuff I look at every day.
Yeah, I definitely think that it would certainly make sense to keep an eye on something like this. I'm a big fan of divergences. I mean, I like to have confirmation. So if prices are going up, it could be confirmation in terms of how consumer discretionary is doing versus staples. It could be how technology is doing versus the S&P 500. It could be banks versus REITs. It could be all kinds of different things. But I think this is, looking for a breadth kind of a move where you're getting that technical confirmation from a lot of components makes sense to me. If they're not confirming as you're breaking out, it seems like that could be a warning sign. And I personally wouldn't act off of a negative divergence, but it would, I'd have question marks. I mean, I would be looking for reasons why I should ignore that signal. And it also would probably it would make me be much more cautious. The fact that, following some of these negative divergences that you're showing, because the stock market has had a history of falling significantly after that, I think if nothing else, it tells everybody, make sure you got your stops in play.
Yeah. The weakness to this is this is an equal weight, and each stock gets a vote, equal vote, whereas the index itself is cap weighted. So I don't know, the last time I looked at it, I used to track it. The S&P 500, the top 50 stocks account for 50% of the weighting in the index. It's, because they're all large cap, but the really super large caps can still carry, as you can see, while these others are dropping, you can still carry the index for a lot longer than you can stay solid, as it's.
Mm-hmm. Now I'm looking at this chart and I'm not really seeing the opposite true. I mean, when I look at the bottoms, the various bottoms over the past couple of years, I'm not seeing positive divergences. I don't know if you see any. I'm not really spotting anything that.
Right here you do.
Where is that? Where is it?
In 2016, you've got a series of higher lows in that. Can you see it there?
Yep.
Okay. Whereas there's the final low in price, and and this was a higher low. That's I haven't studied the bottoms that much. Obviously, you're going to get percentages are going to be different. Like for here, you could get a percentage change up to here, it'll be 100%. So you have to be wary of that. But when you get this low, this is just about as bad as it'll get. And so when it reaches this level, the zero line, it's time to be looking for a rebound of some kind.
Yeah. Well, I got a question for you. Do you follow Dow theory?
I'm aware of it, but no, I don't.
All right, I'm going to pull up a chart. And so once I'm done, you feel free to take the screen back and show whatever you want to show. But I'm following. It is one thing that I think is important. I think the market can go up. The Dow can go up and set new highs without the Dow transports doing the same. But I think it's been clear throughout this bull market that when we finally do get that confirmation on the transports, it can make a big, big difference. So what I have here is a chart that shows the Dow Jones Industrials weekly throughout the bull market. So back 2009 till now, and you can see the uptrend remaining in play. And then down below is the transportation average. And what I found is that when the Dow would break out, so back in early 2012, and for those who maybe aren't familiar with the Dow theory, it simply looks at the Dow Jones Industrials and also the Dow Jones Transports. And if one does something, it looks for the other to do the same thing, whether it's a breakout or breakdown, but especially breakout. And once they both break out, that's confirmation. And so here back in 2012, you can see the Dow Jones Industrial Average broke out to a new high. But when you look down here at the transports, we had not seen that breakout yet. And it wasn't until almost a year later that the transports finally made the break. And you can see that while the transports were struggling, the Dow Jones didn't exactly fly. But once we got that confirmation on the transports, you can see the transports took off, and look at what happened to the Dow Jones. And then once again, we go through a period of consolidation, 2015, 2016. And here's that blue dotted vertical line again, showing that the Dow is moving to a new high in the summer of 2016. But you can see transports had been struggling for quite a while and were nowhere near a high. Well, about 6-8 months later, well, actually less than that, probably about 5 months later, you can see that the transports finally made the breakout. And of course, the Dow was breaking out as well. And then both went on another run to the upside. Well, just recently, we did this again. The Dow Jones broke out to a new high and so far has pulled back. But you can see the transports were nowhere near. And I've written a lot about this. I think that there are a couple of things that really trigger big bull market advances. And one of them is when the transports are going. And right now, they're just not going. And I'm not saying that they're not going to go. I'm just saying that that would be major confirmation, in my opinion, somewhere down the road, if we were to get the transports to break out. And I didn't know if you followed it. I don't know if you have any comments, or Aaron, if you have any comments, but it's something I'll be watching very closely in the balance of 2019 or even into 2020. If this market does put in a bottom at some point and try to go higher, I think we're going to need the transports coming back. Any comments on that?
Aren't there cases where the transports break out first ahead of the industrials, as if they're anticipating an increase in productivity or whatever?
Yeah. Yeah, I was just looking back. I haven't really seen that much in this bull market. I would say maybe we saw that back in October of 2010. It looks like we broke out here, and maybe it was just after that we broke out, probably not more than a week or two, but with the Dow breaking out. But as I look back throughout this bull market, I don't really see that anywhere. I see the Dow going up and then the transports finally making the breakout to confirm. But I think the Dow theory goes either way. I think it looks for one to break out and the other to confirm.
Right.
Yeah, I was looking at some of those divergences too, right at the end of those rises in the transports, like at the end of 2014 into 2015, your tops are declining, the market is still rising, that gave us some warning there. And look what we're looking at now, two tops that are lower, actually the last couple of tops. And that certainly, I would say, is a negative divergence.
Yeah, I completely agree. I mean, this has been, if there were two things that have bothered me about the market, and I'm on record, I've been very bullish, and I actually still am. I still believe we're in a secular bull market, but I'm not going to ignore the warning signs. And when, we start seeing the VIX up in the 20s, I'm going to have my stops in play. I'm not going to, argue with the market until the market decides it's time to settle back down again. But the two areas that have really bothered me about this whole move, and I think two reasons why the stock market has struggled to really build on its pushed all-time highs, is number one, the transports, which are obviously a huge part of the stock market. I mean, if we're moving to all-time highs, we should have a pretty good economy in play, and transport should do well in that kind of an environment. We're not getting that confirmation yet. And the other thing for me is small caps. I don't know how closely you follow small caps, Carl, but we've really struggled with the Russell 2000. Not throughout the entire bull market, but again, with the all-time highs that we just saw in the S&P 500 and in the Dow and in the NASDAQ, you've got lower highs on the Russell 2000. So small caps aren't participating, and that's a lot of companies out there not really doing what the S&P 500 was doing. You follow the small caps?
Yes, I do. I keep an eye on them because usually they're going to lead when a new rally starts and a bull market, and then they'll lag near the top. They've been lagging for a long time.
Mm-hmm. Yeah, and kind of like the transports, you can see the Russell 2000 finally made that breakout in 2013, and when they did, we had a really nice run, not in just the Russell 2000, but the overall market. But when this group tends to struggle along with transports, when the transports struggle, that tends to be when the market really has its moments to the downside. And we saw it 2015, 2016. Once we broke out in the latter part of 2016, we had an awesome 2017 into the early part of 2018. But now here we are again, transport struggling, small cap struggling, and eventually leading to the overall market struggling. I don't know. What about you, Aaron? I mean, as far as the small caps go, do you see that
absolutely.
as a problem as well?
Absolutely. We've been looking at that on the DecisionPoint show pretty much every week on Fridays, and, just making a comparison of not only the small caps, but also some of the others, the mid caps and other areas, and noting the fact that they haven't even been really remotely challenging their all-time highs. And that's a problem, most definitely. And, we actually do have a chart pack too. One of our chart lists is all S&P 600, all of our indicators just for the S&P 600. So we keep an eye on that too on Fridays if there's something interesting to talk about.
And then, we just had the GDP come out, and the reason that the GDP was still okay, a big part of it was the fact that their consumer spending was still there. But another factor that I think is contributing to some of the market weakness is that when we look at consumer discretionary versus consumer staples, we're not getting that confirmation on a breakout either. So as we've moved to all-time highs, I mean, if you look throughout the bull market, this ratio tends to go up. We'll go through periods, when the market was struggling back in 2015, 2016, that's when this ratio was just kind of going sideways with no real direction. When we broke out in 2017, we broke out on the transports, we broke out on small caps, we broke out on this ratio. Lots of confirmation for the bull market to the upside. But right now, transports aren't confirming, small caps aren't confirming. And while I'm not overly bearish what's going on here, because we had such a big move on this relative ratio, I think it's okay to consolidate for a while. But as long as this consolidation takes place here, I think that's another thing that's contributing to the market struggling here, because anytime this ratio is starting to roll over, it's telling us that the more defensive consumer staples names are outperforming. And that's another thing that's not good for a bull market. So this would be another ratio or another chart that I would certainly be keeping an eye on as well.
Let me take it back.
Sure.
And I'm not as fast as you, Tom.
That's fine.
There we go. I have, I want to show the chart that we, I'm not sure I have it in this group, but no, I don't have that one here. But I know where I'll find it.
Is it small cap related or consumer
No,
spending?
it's one of the charts I have in my weekly commentary. Here we go, broad market indexes. And it's not formatted for this page, but it still gives you the idea. I keep track of the equal weight RSP for the SP 500, but also mid cap, small cap, and you can see how they're struggling. And today they're not doing so bad, are they?
Today?
The 600.
Let's see. I've got.
It's down a little, but
yeah, on a relative basis, not doing too bad today.
And of course, the Dow, NASDAQ, and the composite index. But yeah, we watch those on a regular basis, and that chart of the equal weight index is one of the ways I keep track of what the smaller cap stocks within the large cap index are doing.
Mm-hmm. Well, I know the small caps. I normally don't look at the S&P small cap 600. I usually use the Russell 2000, but they're similar. And I know that the Russell 2000 relative to the S&P 500 is sitting near a 15-year low, relative low. So this kind of weakness, small cap weakness, has been somewhat unprecedented. And if the market's going to go higher, I think the small caps have to lead to the upside.
Right. Yeah, I totally agree with that. Here's another chart that I look at on a daily basis. This, except for the price index and the VIX, this doesn't update until the end of the day. But this is where we keep track of climactic activities in the short term. We use new highs and new lows, and we can only use that when the market is making new highs and new lows. But here you can see, while the market was making new highs, the number of individual new highs just completely faded.
Mm-hmm.
And then on this decline, we had all this climactic movement here. We have the VIX. We use a reverse scale log chart, and that gives us an idea of overbought and oversold readings. It's getting definitely in the oversold area. Don't know if it's done yet. I was looking for something like this when this thing started, but now I think that maybe we'll make it more like this. Sorry, I don't know how that works. Anyway.
Hey, that's just a live show. That's what we get with a live show.
Right. So anyway, I'm thinking maybe we're into something like this. It's going to be more protracted. Even this was, what was that? I forget what was the percentage on that decline?
It was about 20%. I mean, it was close.
Yeah, okay, it was. So yeah, I was counting that as a cyclical bear market.
Mm-hmm. Yeah, I do the same. I think of this. Some are saying that's not, but I did think that was a cyclical bear, and that's typical of a cyclical bear to not last long. It's not like the secular bears like we saw 2000 to 2002, 2007 to 2009. And it's not unusual. What would be unusual, though, is to have two within about 9 months of each other. So that would be something that would be a little odd if we were to drop 20% or more from the recent high on the S&P.
Here's another chart that we have in the DecisionPoint area. PMO analysis chart. Basically, for the S&P 500 stocks, we track percent above zero. That's the longest term chart. And then crossover buy signals. This is when the PMO moves above its signal line. And then percent of PMO rising. And this is interesting. We can see similar to that moving average chart that I started out with. We're getting these divergences ahead of the price top. So that's something I hadn't noticed before, and take another look at.
Mm-hmm. Yeah, I think any of these broader looks at the market, I think are good, and I think it's a great tool to have to at least alert you to the possibility of maybe a top forming, because capturing gains, I mean, you don't want to ride a bull market to the upside and then ride it all the way back down and give away everything you earned.
Right.
When you start seeing those warning signs, I do think it's prudent to have your stops in play to make sure you capture your gains.
And then this is a chart that I started. This one is a percent of IT trend model buy signals. That means that the 20 EMA is above the 50 EMA on the individual stocks within the index. So up here we had over 80%. Over here we had high 70s. I don't consider that a huge imperative type of divergence, but it was a divergence. This one is calling it the Golden Cross Percent Index, and I bet you can figure out what that is just from the name. That's the percent of stocks where the 50 moving average is above the 200 moving average. And it moves a lot more slowly, but here again, we've had, it's just like the little above 75. Here was not quite as high, but these kind of indicators, they follow the philosophy that things get as good as they're going to get, and then they get worse and worse till they're as bad as they're going to get, and then repeat the cycle. Right now we're up. We've gotten to the area where probably as good as it's going to get for a while.
Mm-hmm. Well, that kind of leads us to the poll question, which we'll pull up later in the show. But basically, is this as bad as it's going to get? I mean, are we bottoming? What are your final thoughts on that? Do you think this is a bottom or not a bottom, or you're not sure?
Well, I was looking for a bounce, which we got yesterday, and now we're retesting. So it could be that we're done with this correction, but reserving final decision on that.
Yeah, I kind of think maybe we could be in an ABC correction, kind of like we saw in May, where we had that initial drop, we bounced back, and then we went one more time to the downside. I would say, though, looking at that chart you have on the screen right there, I think everyone needs to be aware of that double bottom in March and beginning of June, 27, 25-ish, something like that.
Right.
I think that's a level that would really concern me if we drop below that.
Yes. I think
right.
You can take it back now.
Yeah, we're gonna go ahead and move into the 10 and 10, but it's always a pleasure to have you on the show, Carl. I know our audience really enjoys all of your great insight and through years of experience, and just want to thank you again for stopping by today.
Thank you, and happy to be here.
Talk to you soon.
Okay.
All right, Aaron, are you ready?
I am ready. I'm going to just not do the RRG. I thought we'll move right on in. And our first one is Paysign.
Yeah, I was looking at this one. I got a lot of issues here going. I don't like the volume coming in. You can see in the specialty finance area, this has been a really strong stock, but all of a sudden it is underperforming. It's only been the last few weeks, but it's been on heavy volume. And the characteristics of this decline look bearish to me. Breaking below the 20, failing at the 20, breaking to new lows, not holding the prior support like we've done in previous instances. It's just starting to look like a downtrending stock. I would just want to see it get back up above the 20-day moving average before I would be interested again.
All right, and our most popular, we actually have a tie, so we'll look at both of them. Let's start off with Snap.
Yeah, Snap just had a secondary offering, and I think that's part of what's going on here in the short term. Back to the downside. I don't know if it's been priced. If it has, I don't recall what the price was. But I would be watching this gap support right here. It had a huge move up with earnings. I think we could be moving back down to test that area. If we get down there, I think the reward to risk from that area, that level is pretty strong.
All righty. Let's see the next one up. Let's look at, I noticed that they reported earnings, CVS.
Yeah, they came in with great earnings on the bottom line. I think there's still work to do on the chart. I do like one thing though, and that is its relative strength versus its peers. As you can see, it has been really struggling for quite a while, but with this move today, we are actually breaking out on a relative basis. I would like to see it break out on an absolute basis to confirm. I would just hold off for now.
Okay. The other popular one in the chat room was Mr. Softy.
All right, Mr. Softy. I like Mr. Softy. It has pulled back. I think that there are a couple things to watch here. Number one, relative to its peers, it's been doing great. Relative to the S&P, it's been doing great. And there was a breakout right here above this double top. And we haven't lost that. When we came back down below these moving averages, what I think is going to happen is probably sideways consolidation for Microsoft for a while, unless the overall market just falls apart. Microsoft relative to its peers in software just broke out again. I don't see any massive volume. I do see some increase in volume, but I think unless we lose 130, I wouldn't be too concerned with Microsoft, especially given the fact that it still remains one of the leading stocks within software.
All right. Let's see. Next one, Kohl's, KSS.
All right, Kohl's, it is in an area of the market that has not been particularly strong, and this is not one of the better stocks. So apparel retailers, if we're just going to annotate here, first of all, I'm going to probably, for the most part, stay away from retail apparel retailers because of this. It's just a group that's not performing well. And then not only that, but you've got Kohl's being one of the worst performers within the group, which has been so bad. Horrible volume trends. Yeah, we had a little bit of movement back to the upside, but we failed right at the bottom of gap resistance and have rolled back over. Needs to hold this moving average, but given the relative weakness, I don't like this one at all.
All right. How about SunPower Corp? It's our only energy request, SPWR.
Yeah, SunPower, I kind of like. I think this one, along with Enphase, are my two favorites in the renewable energy space. And you can just see the huge outperformance versus the renewable energy. And look at renewable energy versus the S&P 500. I mean, this, in a nutshell, is the perfect kind of stock for me because I'm trying to outperform the S&P 500. When I got a stock going up like this, on those with those kinds of volume trends, the group is going up, the stock relative to the group is going up. Relative to the S&P, it's killing it. And then here's your group versus the S&P 500. I mean, these kinds of stocks, as long as they continue to show the strength and it's got the volume, I would be interested in them. So I think it's a really good one.
All right, excellent. We haven't looked at this one, but I know we've talked about it. Roku.
They report after the bell tonight, and that's going to be a very interesting report. Because when you look at the overall group that it's in, the computer hardware space, I think part of the problem here is that the group has not been great. And of course, computer hardware is an area that is hit pretty hard by these the tariff scares. So if the overall group is struggling, you don't want to lose any kind of relative strength. And right now, so far, I would say that Roku has not. So we are trending higher on a relative strength basis. Where this stock opens tomorrow could be anyone's guess. I'm going to say that there's your range. I think a gap up above the range would be very bullish. Gap down below this range, I would be much more cautious.
All right. How about a semiconductor for you? Lam Research, LRCX.
Yeah, the semiconductors also tend to get hit pretty hard with all the trade talks because so many have relationships and do a lot of business in China. Here you've got the semiconductors getting hit pretty hard during this move to the downside, and Lam Research also coming down pretty hard, but on a relative basis, actually going up. So my guess is that when the semiconductors bounce, you're going to see Lam Research break out to a new relative high. I like what's going on under the surface here, and this is the reason why, right there. I really like that. We're not too far from a 52-week relative high. I think that this 50-day test down here is probably not a bad area to think about getting in. That's kind of the area of congestion I've seen over the past 3 or 4 months, and we're down in here. So I think you keep a fairly tight stop. So I think LRCX makes a lot of sense.
All right. How about looking at a utility, Duke Energy Corp, DUK?
Yeah, Duke just reported earnings, I think, yesterday. Not really seeing a breakout or a breakdown. The relative weakness here is a concern. So I would just say right now, even though the group continues to trade higher, we've just been consolidating here with Duke Energy. And so right in there is the trading range. We're sitting almost right in the middle of it. I don't see a reason to trade this stock. I think you'd probably find some others that are better suited for a trade if you're interested. Unless we can get this breakout. If we get the breakout, then I'd reevaluate. But until then, I'd avoid it.
All right. And our final one is going to be NXPI.
All right, another one in the semiconductor area.
Indeed.
Yeah, I mean, I kind of like the look of this chart, and there's another one up near the 52-week relative high. It's just the overall semiconductor group. And on the selling here, I would say the volume's just kind of been average. We don't have a perfect ascending triangle, but because we didn't get an equal high, but we got pretty close. I mean, you can see that would have been an equal high. And then, of course, the uptrend off of the bottoms here, right in here, would be that ascending lows. So it's kind of like a little bit of a ascending triangle off of this longer term uptrend. A breakout above 107.50 obviously would be very bullish. To the downside, maybe you just follow this trend line in the 50-day moving average. Be careful if you close below about 95.5, 96.
All right, there you go. That's our 10 and 10 and all of the symbols that Tom just went over. It is now time to close this show, though. It's hard to believe. I do want to tell everybody that, if you enjoyed hearing Carl's take on the markets, he does do a weekly wrap in the DecisionPoint blog that is free. And then we also have our free DecisionPoint show, which airs at 1:30 on, 4:30 p.m. Eastern on Fridays.
All right. Oh, I think maybe we got time to check out that poll to see what everybody else thinks about whether this is a bottom in the Dow. And 60% saying no, 20% don't know, 28%, and only 12% saying this is a current bottom, short-term bottom for the Dow.
Go first.
I'm going to say no. I mean, well, it depends on, I guess, I could see a short-term bounce, but I think the overall decline, kind of like we saw in May, I think the only thing that ends it is if the Fed comes out and says something to indicate that they are willing to lower rates. Short of that, because I think this is Fed-induced. Some look at it as trade-induced. I think it's Fed-induced. I don't think the trade war is helping, but I think this is Fed-induced. If you look back at the last 3 big declines in the market, and I'm talking about 1 week, big declines, they've all followed the Fed meeting. And the market is looking for direction from the Fed, and they're not getting it. They're not getting that transparency that Bernanke and Yellen worked so hard at for 10 years. And I'm not impressed with this Fed. I'll be quite honest. I think anybody listening to the show probably knows that.
I would say they probably do. You know what? I'm going to surprise the heck out of everybody and be with the minority and say yes. Not that this is the lowest price level, but I think we're getting ready to put that bottom in. I don't think that we're going to get any lower than that previous low we saw at the end of May at the worst. But I'm starting to see that climactic activity on the VIX and on breadth. And for me, I'm thinking we're really stretched out. So I think it'll be like May, though. I don't think we're going to get a huge, resumption of a really long-term rally, but I'm looking for some opportunity here very soon.
All right. Yeah. I don't really disagree. I wouldn't be surprised at all if we get a short-term bounce. I just don't think we're going right back to the highs. I think that this is a downtrend that's got to run its course. And unless, like I said, the Fed comes out with some kind of an announcement, shocks everyone, I think that would be very, very well received because it'll have the effect of lowering the dollar, which is also a problem, the currency between the dollar and the yuan. And, there's just a lot of different things that I think we have to
work out.
Yep, no doubt. All right. Well, it was great having your dad on, Aaron. So definitely give him our thanks for that. And also super glad that everybody else out there decided to come in and join us as well. Please remember to complete the survey as you exit. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1 p.m. Eastern Standard Time. Have a great Wednesday afternoon, everybody, and we will see you back here tomorrow. Happy trading.